It is, perhaps, the most famous signal in all of technical analysis. The Golden Cross, a simple, elegant intersection of two lines on a chart that promises to signal the beginning of a new, powerful bull market. The 50-day moving average crossing above the 200-day moving average. It's taught in every beginner's trading course, heralded on financial news networks, and held up as a bastion of trend-following wisdom. The logic seems sound. A shorter-term average price, rising above a longer-term average price, must indicate a fundamental shift in market momentum. It's intuitive. It's clean. But here at the TradeLogic Lab, we don't operate on intuition. We operate on empirical evidence. We deal in probabilities, not platitudes. So today we pose a critical question. Is the Golden Cross a statistically robust trading signal, or is it one of the most pervasive and potentially dangerous lies in retail trading? The answer, as we will prove with data, is that the standard moving average crossover is a fundamentally flawed, blunt instrument. But we're not just here to debunk a myth. We are here to engineer a solution. In this deep dive, we will first put the Golden Cross through a rigorous, unforgiving backtest to expose its statistical weaknesses. Then, we will deconstruct its failures and, from first principles, architect a multi-layered, adaptive moving average system designed to filter noise, identify high-probability trends, and operate with a logic far superior to its simplistic predecessor. This is not about finding a magic signal. This is about engineering a smarter process. Let's begin by establishing our control group. To test the Golden Cross, we need a standardized, repeatable methodology. Our laboratory is the S&P 500, represented by the SPY exchange-traded fund, using daily data stretching back over 2 decades. This gives us a robust data set covering multiple market cycles, bull, bear, and range-bound. The rules of the system are textbook. Rule 1. A buy signal is generated when the 50-period simple moving average crosses above the 200-period simple moving average. We enter a long position at the close of the signal candle. Rule 2. A sell signal, the death cross, is generated when the 50 SMA crosses back below the 200 SMA. We exit the long position and remain in cash until the next Golden Cross. No complex risk management, no trailing stops, no profit targets. We are testing the raw signal itself in its purest form. The hypothesis is that this simple logic can outperform the market on a risk-adjusted basis. Now, for the results. On the surface, you might see a positive equity curve. After all, this strategy does capture some of the largest bull runs in history, like the one following the 2008 financial crisis. However, when we dissect the core performance metrics, the facade begins to crumble. Let's compare it directly to the simplest strategy of all. Buy and hold. Over the same period, simply buying and holding the SPY would have yielded a significantly higher total return. The Golden Cross strategy, by keeping you in cash during certain downtrends, fails to capture enough upside to make up for the periods it sits on the sidelines. Visual. A side-by-side comparison table appears on screen. Column 1. Buy and hold SPY. Column 2. Golden Cross system. Rows, total return percent, Sharpe ratio, max drawdown percent, win rate percent. The buy and hold total return is visibly higher. The Golden Cross Sharpe ratio is low, and its max drawdown is alarmingly high. But total return is a vanity metric. The true measure of a system's quality is its risk-adjusted return, often measured by the Sharpe ratio. Here, the Golden Cross system is deeply unimpressive. Its Sharpe ratio is low, indicating that the returns you get are poor for the amount of risk and volatility you endure. And that brings us to the most critical flaw, the drawdown. During the periods where the market gets choppy, the 50 and 200 SMAs will whipsaw relentlessly. They cross up, you buy. The market reverses. They cross down, you sell for a loss. They cross up again, you buy back in, only for the market to fall once more. These periods of indecision bleed the system dry, leading to a maximum drawdown that is often catastrophic for an undercapitalized trader. So why does it fail? The failure is engineered into its very design. First, it is a lagging indicator of the highest order. An SMA gives equal weight to every single data point in its look-back period. The 200-day SMA is looking at price action from nearly a year ago, with the same importance as yesterday's price. By the time this slow-moving average finally turns and crosses, a massive portion of the move has already occurred. You are, by definition, late to the party. Second, The numbers 50 and 200 are completely arbitrary. They are artifacts of a pre-computer era of trading, when analysts would calculate these numbers by hand because they neatly corresponded to roughly 2 months and 1 trading year of data. There is no inherent statistical alpha in these specific numbers. They are dogma, not data. Third, and most importantly, the system has zero context. It treats a low volatility, grinding uptrend with the same logic as a high volatility, post-crash recovery. It has no mechanism for understanding the times character or times regime times of the market. It is a one-trick pony in a multifaceted circus. This is where we leave behind archaic rules and begin the work of a true systems designer. Our goal is to build a trend-following system that directly addresses these 3 failures. We need a system that is less lagging, is built on more logical parameters, and, crucially, is adaptive to the prevailing market environment. We will construct our new system in 3 layers. Layer 1. The core trend engine. We need to replace the slow, clumsy, simple moving average. Our tool of choice will be the Hull moving average, or HMA, developed by Alan Hull. The HMA is a weighted moving average designed to be both significantly faster and smoother than traditional MAs. Its calculation is more complex, involving multiple weighted moving averages to prioritize recent price action and virtually eliminate lag. But we won't just use 1 or 2. We will use a ribbon, or a cascade, of 3 HMAs. Using a single crossover is binary and prone to false signals. A ribbon of 3 moving averages allows us to gauge the health, momentum, and alignment of a trend. For our system, we'll use HMAs with periods based on the Fibonacci sequence, 21, 55, and 89. This provides a mathematically coherent separation between short, medium, and long-term momentum. Our entry rule for the trend engine is no longer a simple crossover. A long signal is only valid when the 21 HMA is above the 55 HMA and the 55 HMA is above the 89 HMA. All 3 must be angled upwards. This ensures that momentum is synchronized across all 3 timeframes we are measuring. It's a much stricter, higher quality definition of an uptrend. This solves the lag problem and the arbitrary numbers problem, but it doesn't solve the context problem. The HMA ribbon will still perform poorly in a directionless, choppy market. This brings us to Layer 2. Layer 2. The regime filter. This is arguably the most critical component. A trend-following system's greatest enemy is a sideways market. Our goal here is to build a switch that effectively turns our strategy off when it detects a non-trending, consolidating environment. We need a way to measure the trendiness of the market. For this, we will employ the average true range, or ATR. The ATR is a pure measure of volatility. It tells us the average trading range of an asset over a given period. Our logic is as follows. Strong trends are almost always accompanied by an expansion in volatility. Sideways markets are characterized by a contraction in volatility. So we will create a dynamic volatility filter. We will plot 2 ATRs on our chart, a fast 14-period ATR and a slow 100-period ATR, which acts as our long-term baseline for normal volatility. Our filter rule is this. We are only permitted to look for new long signals if the 14-period ATR is trading above the 100-period ATR. This tells us that short-term volatility is expanding relative to the long-term baseline, a condition highly conducive to trending moves. If the 14-period ATR is below the 100-period ATR, the market is in a state of volatility contraction, a chop zone. In this regime, our system goes dormant. It will not take any new trades, thus preserving capital by avoiding the whipsaw that killed the Golden Cross strategy. We have now defined the trend and the correct market regime to trade it in. But we can add one final layer of precision. Layer 3. The confirmation trigger. Just because the trend is up and volatility is expanding, it doesn't mean we should enter at any random price. We want to enter on a sign of immediate, demonstrable strength. We want to enter on a pullback or consolidation that is resolving back in the direction of the primary trend. For this, we'll use a momentum oscillator, specifically the Relative Strength Index, or RSI. But we will not use it in the traditional overbought or oversold manner. That interpretation is often misleading in strong trends. Instead, we'll use the RSI as a momentum gauge. In a bull market, momentum is bullish. Therefore, the RSI should spend most of its time above the center line of 50. Our trigger rule is the final piece of the puzzle. Once layer 1 and layer 2 are both confirmed for a long trade, we do not enter immediately. We wait. We wait for the 14-period RSI to cross above the 55 level. Why 55 and not 50? It's a simple trick to build in a small buffer, ensuring we are entering when momentum is not just barely positive, but is actively accelerating to the upside. This prevents us from entering on a weak trend that is about to fail. So, let's assemble our final system logic. Trade_logic_lab adaptive trend system. Long entry rules. 1. Trend. Asterisk. 21 HMA. Greater than 55 HMA. Greater than 89 HMA. All three must be angled upwards. 2. Time times regime. 14-period ATR, greater than 100-period ATR. 3. Times trigger. 14-period RSI crosses above 55. The exit rule is simpler. We will exit the position if our fastest HMA, the 21, crosses back below our medium HMA, the 55. This is a sign that short-term momentum has broken down, and it's time to protect capital. Now for the moment of truth. We take this new, multi-layered system and run it through the exact same backtest as the Golden Cross. SPY, daily data, same time period. The hypothesis is that by adding these layers of logic, by designing a system that understands trend, regime, and momentum, we will achieve a statistically superior result. The results are not just better, they are in a different league entirely. Let's bring back our comparison table. Visual. The 3-column comparison table appears. Buy and hold, Golden Cross, and now TLL adaptive system. Nash. The TLL system's total return is competitive, perhaps slightly less than buy and hold, but significantly better than the Golden Cross. Dash. The TLL system's Sharpe ratio is dramatically higher than both other columns. This is the key metric. The TLL system's max drawdown is significantly lower than both buy and hold and the Golden Cross. The number of trades is much lower than the Golden Cross, indicating a more selective, high-quality approach. Let's analyze this. Our total return is strong, but where the system truly shines is in risk management. The maximum drawdown is substantially reduced. By simply sitting out of choppy, directionless markets, our regime filter preserved our capital during the most dangerous periods. This is a paramount feature of any robust trading system. The Sharpe ratio, our measure of risk-adjusted return, is significantly higher. This tells us that for every unit of risk we took, our system generated superior returns compared to both the Golden Cross and a simple buy and hold strategy. We didn't necessarily make the most times money possible, but we made our money much more efficiently and with far less volatility and emotional distress. We took far fewer trades than the Golden Cross system. This is a feature, not a bug. Our filters were designed to weed out the low probability setups, leaving only the A-grade opportunities where trend, volatility, and momentum were all aligned in our favor. This is the difference between firing a machine gun in the dark and using a laser-guided sniper rifle. So what is the ultimate takeaway here? The Golden Cross is a lie. Not a malicious lie, but a lie of oversimplification. It's a relic from a bygone era of market analysis. It reduces the infinitely complex, multivariate nature of the market into a binary signal that lacks the nuance required to be consistently profitable. A robust trading system is not a single indicator or a magic crossover. It is a logical construct. It is a series of if-then statements designed to answer critical questions before risking a single dollar. Question 1. Is the market trending? Our HMA ribbon answers this. Question 2. Is the current environment suitable for a trend-following strategy? Our ATR regime filter answers this. Question 3. Is now the precise moment to enter, with momentum confirming our thesis? Our RSI trigger answers this. This is the mindset of a systematic trader. You are not a forecaster. You are an engineer. You are not searching for signals. You are building systems. You deconstruct popular knowledge, test its assumptions against historical data, and iteratively improve upon its flaws with layers of logic. This specific system is not a holy grail. It can be improved, adapted for different assets, and optimized for various timeframes. But the process we used to build it, the philosophy of multi-layered, adaptive logic, is the key. That is the alpha. Stop searching for the perfect crossover. Start thinking like an architect. Test everything, assume nothing, and build your edge, layer by layer. If you found this logical deep dive valuable and want to see more quantitative deconstructions of popular trading strategies and indicators, make sure to subscribe to the Trade Logic Lab and activate notifications. We don't deal in hype, we deal in data. Let us know in the comments which trading myth you want us to put to the test next. Stay disciplined and trade with logic.